Across my different investing spreadsheets, I have many different companies that I track all different types of numbers and metrics and all types of other data that I think is important, including all of my investments that I'm currently invested in. And I see many different pieces of data that I think is important and I try to keep track of, but I also include a couple other companies on the watch list that I currently don't own. One of them is Crowdstrike. Crowdstrike is one that I've been a huge fan of, and I typically have been planning on investing in this company throughout all of 2022 and beyond. They just reported their earnings, and it came in stellar. The growth was through the roof. They reported in a recession. Keep in mind, this is time when typically jobs are being lost, money is being restricted, and generally overall, money is just a little bit tighter out there, and this company just grew 52.84%. I'm going to talk about how they did that, what they're doing with their business, and we have a lot of different pieces of information to go over. I have a bunch of slides prepared for you, so stay tuned. It's going to be a fun one, and we're also going to talk about in this video why the stock dropped. Because when you look at these numbers and you look at the rising revenue, the rapid growth, you would probably think that the stock soared. Well, actually, you'd be wrong. The stock dropped $20, over $20 today, which represents about a 15% downturn. Now, that is despite the market having an incredible day. The NASDAQ went up over 4% today, and still, this company fell 15% despite it even being an incredible green day. If today were a big red day, it would probably be down 20% plus. So we're going to talk in this video what we're going to look for. We're going to talk about shares outstanding. We're going to talk about cash flows. We're going to talk about balance sheets, the overall trends, the actual fundamentals of the business. We're going to talk about qualitative, quantitative, all that good stuff. But before we get into all that, we have to talk about today's sponsor, MooMoo. MooMoo is a new up-and-coming brokerage that is taking the world by storm. Commission-free trading, level 2 data, advanced technical indicators, earnings calendars to see the date of financial statement releases, and institutional tracking to follow Warren Buffett's portfolio are just a few examples of what MooMoo has to offer. With this being my first sponsor in the channel, I have fully vetted their company and stand behind their vision. MooMoo currently trades on the NASDAQ under ticker symbol FUTU for FUTU and is SIPC insured. If you sign up today using my special referral link, then you can receive $10 plus an additional 15 free stocks pending certain deposit requirements. Free stock amounts can be as high as $1,000, so sign up now using the link in the description or pinned comment down below. You would help support me and my channel by doing so and give yourself an edge in the world of investing. Thank you so much, MooMoo, for sponsoring this video. Now back to the content. Welcome back, and let's go ahead and take a start by looking at this company's guidance. Now, what I'm showing here is this was 3 months ago. This was a quarter ago, and what we're going to look is this highlighted column on the right side that says full year 2023 guidance, okay? Now, they projected 2.22 to 2.23 billion, so generally about 2.23 billion, and they maintain that number. It's almost identical. It's actually a teeny tiny bit higher, but it's basically identical to what you're seeing this quarter. Now, last quarter, you notice if you look at these numbers, which generally comes down to the cash that they're getting from operations and their earnings per share, generally went up. From an average at around 325 million in income from operations, that has now increased to around 350 million income from operations. Same things with earnings per share. It was originally about $1.30, and now it's going to be projected about $1.50. And the main thing that we're going to talk about why this company dropped, and we're going to discuss it throughout the video, what I think about it, how they're going to counteract this, the good and the bad. Generally speaking, when you look at this revenue growth, you think fantastic growth. The recurring revenue of this subscription-based company is rapidly dominating the cybersecurity space. And if you're not familiar, by the way, this company obviously sells cybersecurity products. Google the basics of the business if you're not familiar. But the number one reason why it drops is because of this reason right here. Crowdstrike sees fourth quarter sequential drop in recurring sales as clients take longer to close subscription deals. What you might not know is what a sequential means is quarter over quarter. So for example, the customers that they have this quarter, which as of right now sits at 21,146, they expect that at the end of this quarter, at the end of the year, they're going to have less than this. So probably right around 21,000 and some change. So they're probably going to lose a small amount of clients as some companies have closed down, or they've left for other services, or they just overall just haven't grown the platform like they expected it to grow. Now, everything else came in great, but that one piece of bad data led to the stock falling $20 plus. And if you look at the stock price since it went IPO, you can see that it went IPO in 2019. This company, I've been been following since about mid 2020, shortly after the pandemic, when it was around $120 or so, and that's basically where we're at today. Over the last 2.5 years, the stock is basically flat. If you look at the 2-year return, actually no, let me rephrase that. If you count today's downturn, it's down 20%, and if you look since IPO, it's still doing okay. It's up 103%, but that's a far cry from its previous all-time high at around $300 a share. Today's downturn at 16% was pretty dramatic, and I typically don't expect a company of this caliber to be falling that much on its earnings report. Now, let's go ahead and start by talking about the elephant in the room, the big problem, their expanding customer base, or I should say lack thereof, because this customer base is no longer growing. It's a problem that Crowdstrike is now facing. They cannot grow customers. And the main problem I see here is that if you look at their main bullet points, while as incredible as this is, you see that they have 69 of the Fortune 100 clients on their books. You see that they have over half of the Fortune 500, which is just incredible. Of the top 20 banks, they have 15 of them, which is critical for cybersecurity because banks have financial information, they have social security numbers, they have all types of critical stuff that you cannot leak. And while this number is growing at 44% year over year, I think it's safe to say after their announcements this quarter, it's going to be dramatically slower. Now, the good news is despite their customer base slowing, they are expanding their TAM, which is total addressable market. And you can see how that's broken down here. Whether it's IT operations management, log management, threat intelligence services, data protection, or many other types of categories, you can see at the compounded annual growth rate of the overall TAM of the business, the actual market that they can address, is growing at around 13% compounded. So even if this company didn't grow any clients, they didn't sign up any new people, just the market itself is going to grow 13%. And you can see how this is reflected in not only the starting, but the net new ARR, which stands for annual recurring revenue, which grew 54% year over year. Now, the main thing I want to talk about here is how this company is growing. You might be looking at this number, you might be looking at this massive revenue growth and saying, Jordan, they're still growing 50% year over year, over 50%, it's 53% to be exact. And with them growing that fast, how can they be growing if they're not actually signing up a ton of new customers? Well, that's because of this number right here. This slide is, my opinion, let me take that back. It is the most impressive part of Crowdstrike's business. Now, one of my largest investments is Salesforce, okay? If you look at Salesforce, it currently makes up right around 36% of my portfolio. And this is a large investment for me. And what they have to do is they constantly have to sell their cross-selling products to other existing customers who hopefully sign up for one cloud and then expand into new products. And this can be shown right here, which we'll be comparing this with Crowdstrike. They typically try to keep around 90% plus of their revenue. Off the top of my head, I can't remember. I think Salesforce tries to keep like 94%, if I'm remembering correctly. Now notice that this number is dramatically higher for Crowdstrike. As of the time that they reported this last on this slide, it was 124%. What that means is that their existing customers, the ones that leave, they're making more money from the customers that stay than the number of customers that leave. So for example, if they signed up 0 customers throughout the year of 2022, if this rate held constant, they would have grown revenue 23.9%. They're growing revenue faster than the rate at which clients can leave because they're cross-selling all these products from these new TAM opportunities like we talked about. Their main core product, the $22 billion opportunity right here, is just flat out their main core business. All these other add-ons have been added on within the last half decade, and they do an incredible job of cross-selling the client. That is awesome to see as an investor if you have money invested in this stock. And this leads me to Salesforce, how they have a huge percent of their customers making up a small percentage of their client base. Now, if you look at this holds true once again with Crowdstrike. You can see that the bulk of their customers are deeply invested. They don't have one product or 2 products. Almost all of them have 5 or more modules. And the people that are really making the money and are locked into this product is this column right here, the 7 or more modules, which makes up 21% of their client base. Notice how when we look at Salesforce, the reason this company has grown and the reason why they're so successful, it's not for these people that are just dipping their toes in the water, getting started. They have 1 or 2 products. That makes up the smallest percent of revenue, but the largest number of clients. 85% of the revenue come from people that are fully committed to the products at 4 clouds or more. The same thing can be said for Crowdstrike. The people that really bring in the dough are the people that are fully committed, that have 5, 6, or 7 modules. Now, I want to talk lastly, and how I want to end up here is talking about profitability. If you look at the free cash flow, for some reason in Qualtrim, it doesn't have the most recent quarter updated. So keep that in mind. It doesn't have this last quarter. It just shows the one before that for some reason. This will likely be updating within the next hour or so because the earnings did just come out. So keep that in mind. So stay tuned for that. But anyways, you can notice that the one thing that I typically look at with companies is growing free cash flow. Like for example, we've talked about Salesforce in this video, and one of the main things that I'm looking at is for growing profitability. Specifically, growing free cash flow. I like net income, but free cash flow is what I'm looking for, and that's what leads companies to buying back their shares, to reinvesting back into the business, and typically companies that have growing free cash flow have growing cash piles. Notice how you see that with Salesforce. The company gets more and more safe and more dominant because their cash pile over time is growing. And then notice, while this company, this is a perfect example by the way, this was a dilutive company that issued more shares every single year, and now that if you look at this quarter, for the first time they're buying back shares, it actually went down quarter over quarter. So that's something cool to see. Finally, Salesforce is using its cash effectively to reinvest back into itself. I see a similar pattern starting to play out for Crowdstrike, who's just a little bit earlier in the game. You see a very similar story. You see a debt pile that is staying flat, not growing at all, which is a good thing because their debt pile is very small. And when you look at their cash, it is not even comparable. Look at these side by side, it's not even close. And then the cash pile is just trending up and to the right every single quarter. That's because of all the free cash flow this company produces. Free cash flow is what I'm looking for. And by the way, this $32 billion market cap is not updated. It doesn't reflect today's drop. So after today's drop, it's actually around a $27, $28 billion market cap. And when you consider that last year they put up $444 million of free cash flow, they've already done more than that than the first 9 months of the year. Last year they did 442. The first 9 months of this year, they're at 467. That doesn't even count the last quarter, which is obviously already going to be a lot higher. And so far, this represents 49% year-over-year growth. That's what I want to see. This is leading me to why I will consider investing in this company, because as you can see from the targets on the right, pause the screen if you want to look over this yourself, but they're targeting 30% free cash flow margins, which is very strong, very good for what I want to see in this company. So will I buy the stock? I'm personally looking to buy it right around $100. It depends on what I do with my other holdings. Like I mentioned, I'm looking at exiting my Crocs position because Crocs stock has went up so much, it likely will not be going up very much more in the near term, so I might be exiting out. So I'm probably going to take some profits from Crocs stock, and if I do so, I will likely be putting it into Crowdstrike, not on a valuation play, but strictly because I'm so confident in the business. When you look at numbers like these, when you look at these different pieces of data, this is just flat out simply a company I want to own, a business I want to be a part of. So for that reason, that's why I'm potentially going to invest in Crowdstrike. I don't have any shares yet, but stay tuned, that could change very soon. Thank you guys so much for watching. Appreciate you watching all the way to the end. Check out all the stuff down below in the description, including MooMoo if you haven't already. And without further ado, my name is Jordan. I'm a Millennial Investor, and I'll catch you guys next time.